You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning in to this week's episode of the Tax Smart REI Podcast. Today we're joined with Tait Duryea live at the 2025 Tax and Legal Summit. Tait is founder and CEO of Turbine Capital. As an experienced airline captain and third-generation aviator, Tait combines deep industry knowledge with more than a decade of real estate experience across single-family, multifamily, self-storage, industrial, mobile home parks, and short-term rentals. In 2020, he launched Turbine Capital to provide pilots with access to institutional quality real estate and alternative investments traditionally reserved for ultra-high-income investors. He later expanded his impact with the launch of the Passive Income Pilots podcast in 2023, which has quickly become one of the fastest growing financial podcasts on Apple and Spotify. We're going to be diving into all of that good stuff in just 1 minute. After talking with clients and fellow real estate investors, one thing was clear. There wasn't a newsletter that delivered real market insights, concise decision-making info, and relevant tax strategy all in one place. So we created it. REI Daily delivers real estate news that won't put you to sleep, real and concise market insights that aid in your decision-making, legislative updates that actually impact your investments, and tax strategies sprinkled in because the IRS does not need a tip. If you're a real estate investor who wants to stay sharp without shifting through all of the clickbait or fluff, this is for you. And to celebrate the launch, you'll have a chance to win a free one-on-one tax strategy call with one of our top real estate experts. No pitch, just strategy. Subscribe now by visiting www.therealestatecpa.com/subscribe. Again, you can subscribe now by visiting www.therealestatecpa.com/subscribe. We'll see you in the inbox, but now right back to the show. Tait, could you just give us kind of an overview of how you kind of got involved in real estate?
I'm an airline pilot by trade, actually. But the real estate bug caught me very early in life. I had some great mentors when I was growing up, namely two of my uncles who were both pilots. One of them I was really close to because he didn't have kids and he was sort of the funkle, right? And he was very financially savvy, but he was a stock market guy. And, he was the one that gave me the Rich Dad, Poor Dad book when I was really young. And he also gave me some real estate books, and something didn't connect between what I was reading in these books and what was possible if you invested in real estate heavily, you leveraged the tax code, and what he was doing in his life, because he was doing well. Airline pilots make very good money, and he invested a lot of it, but he wasn't killing it. And that set the groundwork for, me going down the rabbit hole of high net worth strategies, alternative investments. So I didn't know what I didn't know, of course. And I started, when I was young. I bought my first property when I was 25 years old. It was a 3-bedroom house in Las Vegas, timed it pretty well. It was in 2012. So I was able to buy below replacement cost, rent it out to a nice family. And that was my foray into real estate. That was, the absolute earliest that I could possibly do it, because back in that era, pilots, when you were coming through the ranks, you didn't make much money. So I was scraping together pennies, and that was the first real estate asset that I was able to buy. And I went from single family to multifamily to LP positions and syndications, and I've invested all over the map. And I'm just really passionate about the alternative investment space, and we can talk about why. But, stocks have a place in everyone's portfolio, of course, but it's not the whole picture. And that's what we educate pilots specifically, and other professionals, about on the podcast, is that there's this whole other world that, decamillionaires, centimillionaires are familiar with, that typical middle to upper middle class people just aren't.
That's awesome. And a lot of people do come from that traditional financial background of everything in the public markets, stocks, ETFs, things like that. There definitely is some room for diversification in there, and, investing in limited partnership interests and syndicates and funds, certainly a way to do that. I know I certainly have exposure there. Out of all the different investment strategies out there, there's BRRRR, there's like a,
which I've done. Buy, renovate, rent, refinance, repeat.
Right. There's that. Then there's just traditional, just like, I'm going to buy and hold, just the turnkey property. There's short-term rental investing, which of course is on fire right now across the US. Why dive into the route you specifically went into?
I didn't have a plan. And I think that's what we help our investors to do, is we illuminate, both my co-host and I, illuminate the path for people. Because when I was coming up in the early 2000s, early 2010s, there was not nearly the amount of financial education out there on YouTube and podcasts, and you really had to go digging for it. And so what we try to do is illuminate that path for people. I was really shooting in the dark. So it was like I didn't know anything other than to just go and buy a single family home. And then you read some more books and you're like, oh, multifamily sounds good. And so you'd make that jump. And there's a whole learning curve, especially in the debt markets when you jump from residential to commercial. And then you realize, gosh, I'm just picking up scraps because all the really good deals have been picked over by professionals. And that's when you say, well, maybe I should just invest with these professionals. And so made that jump and had varying degrees of success. The successful deals were very successful. And so really I got to where I am by making all the mistakes myself, which in aviation, we always say you don't live long enough to make all the mistakes yourself. So you got to make sure that you learn from other people. So we've tried to do that along the way as well. But yeah, I've really taken a roundabout way to where I am today.
Yeah, no, for sure. And, before we kind of get into some of the tax side of things, what were some of the key mistakes that you learned along the way, kind of investing in this type of space yourself, that some other people who might be tuning in who are interested in investing as a limited partner, what advice would you have for them? What mistakes could you maybe help them avoid?
Well, boy, I don't want to take up the next hour, so I'll have to pick a few. So I'd say the first one is if you're going to buy commercial property, if you're going to buy anything that's over 4 units, buckle up because it's going to be a much different experience than what you're used to. Make sure that you get some education, you find some mentors, and you get ready for what that experience is going to be like trying to find debt on that property. Maybe before you go identify that 5+ unit property, start talking to some debt brokers and line that piece of the puzzle up because it can be very difficult, especially if you're out of state, to line up financing on a commercial property when you're jumping from residential to commercial. That's one tip. I also would say that if you're investing passively, newer investors tend to look at target returns. And instead, what you should be looking at is the people. And I love, there was a quote from the CEO of BlackRock the other day, and someone was saying, finance is all about numbers. And Steve, you're not really good. You're not a mathematician. You're not particularly good with math. How did you become so successful in finance? And he said, well, finance isn't really about the numbers. It's about, there's all these models and the models create an output, but really what matters is the inputs. So what are the assumptions? What are the assumptions that are feeding into the underwriting, into the model that produce those outputs? So the output is going to be the target IRR, the equity multiple, the whole time, all those sort of things. There have to be accurate or robust assumptions, reasonable, robust, and intelligent assumptions that go into that model in order to produce those target returns. And that's what people miss when they're newer to alternative investing is they say, well, this deal has a 20% IRR, this one has a 24, I'm going to go with the 24. It just doesn't work like that. And those estimates are going to be wrong the moment you take a property down. I mean, we know we're buying we have tons of deals with our firm, but one of the deals we have is a 56 unit in Tempe, Arizona. We know that the moment we close on that property, all of our assumptions, all of our models go out the window, and we switch from a forecasting position to an operating position. Now we are asset managing and we're property managing and all, the whole thing comes to life. So you really need to evaluate opportunities by reading between the lines, investing in people first, then the deal, then the market, then the deal. But really you're investing in people and you need to be paying attention to those inputs. What's driving those target returns? What's driving the model?
That's great. I love that. I think that's absolutely true. As far as like where we're at, from your opinion, Tait, like within the market, interest rates are where they're at. We're at with the Fed and just things like that. Prices of homes, commercial properties, things like that. Where do you kind of think that we're at as far as where the market's heading, interest rates are heading, things with tariffs that we're seeing that have kind of been lagged a little bit now as far as like importance of what we see in the news. Yeah. But what do you kind of think we're at within the market right now?
Of course, great question. So I think that you can really bifurcate the market into residential and commercial. I think that, my mother, my wife are both realtors, so very familiar with the residential space as well as the commercial space. And when we talk about real estate, we're typically talking about commercial because that's what we do with my firm, and we're all investors, and typically we're talking about commercial real estate. But I think it's important to stop quickly on residential. Years ago when interest rates shot up, everybody thought, oh my God, home prices are going to crash. And I was one of those people saying, no, they're not. They're not going to come down because the rate lock effect. So just a couple minutes on residential, and then we'll pivot to commercial, which I think is more relevant. But on residential, we've had this rate lock effect where I have a 2.5% mortgage on one of my properties from COVID era. I never want to sell that property because I'm putting the majority of my payment every month is going to principal. It just doesn't make sense. And when a homeowner has to sell a property at a 3% mortgage and they relinquish that and they have to buy into a 7% market, their monthly payment, their buying power is significantly diminished. So you have no supply. At the same time, inventory has been very tight. Now, it's been build, baby, build over the last few years, and it's catching up. So for the first time I think in history, but I could be corrected on that, new construction is trading at lower prices in the residential space than existing homes. So that means you can go out and buy a home, a brand new home that was built by Lennar for cheaper because they've got a supply glut. So we are finally seeing high interest rates start to affect buyers, really just giving up and pulling back from the market. But at the same time, sellers don't have to sell. We're at record highs of equity in people's homes. This is one of the highest equity position periods in history where everyone just has a ton of equity in their homes. So most people don't have to sell. So it's creating a market that is very supportive of residential home prices. On the commercial side, of course, debt is your largest single line item expense in any commercial real estate project, typically. And that affects cap rates. So cap rates have been fairly resilient through this debt market increase. Obviously, anything you bought in 21 or 22, whether it's in a syndication deal or you personally went out and bought a commercial property, it's probably not doing all that great. Commercial real estate as a whole saw a decrease in valuation anywhere from 10 to 50% across the board. I think the bulk of the multifamily stock nationwide has come down 30 to 40% from its highs. I mean, the asset that we're buying in a killer location in Tempe right now, 38% below what a exactly similar asset right across the street traded for in 2022. So I think that we are in a fantastic cyclical low. So not to go on a monologue here, but when you talk about where we are in the cycle in the commercial real estate space, we saw this run up after COVID. We've got 100% bonus depreciation. The Fed prints all this money. Everybody's looking for where to put that cash. Asset values increase because institutional capital as well as retail capital is flowing into commercial real estate. We see this big run up. Fed cranks rates 5.5% in 14 months. This was not the biggest, but the fastest rate increase in U.S. history. So we have never seen the Fed funds rate go from 0 to a 5.5% rate as fast as it did. And that was like running commercial real estate into a brick wall. That caused transaction volume to fall off a cliff. At the same time, builders were going nuts because when you saw during COVID rents increasing by 10, 20% year over year and this massive gold rush in real estate, developers went crazy and debt was cheap. And so they started a bunch of multifamily construction projects. We saw, and this is true in industrial, multifamily, a bunch of different asset classes, but we saw this big wave of supply, and that was this 1-2 punch for real estate that was purchased in 2022. Was you've got all this competition from a bunch of new buildings, new multifamily that's dumping into the market in 23, 24, starting to wane in 2025, as well as your cost of capital, if you were on floating rate debt, if you were using a bridge product, went through the roof. I mean, talking about your debt doubling, the cost of your monthly payment doubling in 6 months. I mean, it's catastrophic. You cannot operate a property well enough to outrun that. So, we've seen deals that we have a few that we bought in 2022. We are exceeding the pro forma performance in every single metric, yet we're negatively cash flowing because we got caught off guard with some bridge debt products. So when you look at where we are in the cycle, we've seen this massive drawdown in valuations, increase in debt costs, increase in vacancy, negative organic rent growth, and we're really in the trough now. And looking forward, that supply, that new supply, all of those builders going nuts. Well, now the opposite is true because debt's expensive. It's hard to get deals to pencil. This doesn't get talked a whole lot about, but with the ICE raids and the deportations, a huge percentage of construction workforce in this country is immigrants. You've also got tariffs. So material costs are more expensive. So all of a sudden you went from an environment where it was very easy to build and a lot of projects penciled to it's difficult to build. Entitlement costs are up, labor, material costs are up, and you've got 10% vacancy in a lot of markets. And so a lot of these developers have lost money on deals or gone bust. And so developers have pulled back massively. And now that is against the backdrop of a very healthy market foundationally, where you've got really strong absorption, strong rent growth, I shouldn't say strong yet, but a reversal in that trend where we've come from negative rent growth to now we're bottoming out and it's going positive again. So we think that we are in this perfect cyclical low where it's just a really, really great time to be picking up commercial real estate assets. And we're backing the truck up and getting our hands on as much as we can possibly get. So I talked a long time there, so I'd love to kick it back to your court and get your perspective on that, and I don't know, sort of open it up for discussion.
Ryan, you have any questions there?
No, that's great. I hope that we're kind of seeing a trend, going back up, because I have friends who are in commercial real estate, as you are, Tait, and our listeners and our clients and so forth. So would love to see that be the case, and I hope that is.
I think that you're just seeing that, you can tell where you are in a market cycle by the kind of debt that's being put on projects. Because in a frothy market, it's really competitive. Everybody's trying to buy. And the only way to win a bid, someone's selling a 100-unit apartment complex, the only way to win that bid is to go out and get bridge debt. So, but right now, you're able to get fixed rate financing at 5.5%. I mean, very healthy, conservative leverage. And it's also very difficult to buy because nobody wants to sell because everybody sees the same data that we do, But we just think it's a fantastic time in the market cycle because you don't have to depend on valuations climbing back up, cap rates compressing, rents rising. I mean, we're able to buy with positive leverage. And when you can buy at a 6 or 6.5% cap rate with 5.5% interest debt, that's a good deal. I mean, I don't care where you are, what the asset is. If you can buy with positive leverage at a 5.5% interest rate, it's a good deal. And we're just in a great time in the market cycle, much more healthy than it was a few years ago.
Yeah, it's also very interesting. This is my last comment, then you guys can kind of take back. But just as we've seen kind of, the last few months, I don't know how long this has been going now, so don't quote me on this, anyone, but just as kind of the stock market continues to kind of go up, and we've hit like new highs like for the next last few months, and we've kind of potentially, like you said, in the commercial space, kind of hitting these lows. Right. As we kind of see like, oh, this starts to, perform better. I wonder if we'll start to see like, oh, this has hit a peak, and now kind of prices maybe start to drop here. People move capital from the stocks into commercial real estate, something like that.
Absolutely. And I want to be, we've mentioned this on our podcast. We've mentioned it on some webinars recently, and we're very cautious with this because we don't want to come off as providing financial advice, but you are spot on. I mean, the stock market is soaring, and I'd love to talk about that and the recent executive order about the alternative investments in 401ks. But it can be difficult because everyone has recency bias, right? And if you invested in multifamily in, let's say, 2022, or really anything in 2022, in real estate, it's probably not doing very well. And you're like, ooh, I don't know, my stock portfolio is doing great. I'm going to do more of that. But you really have to think about the fact that these trends don't draw themselves out in the same direction into perpetuity. And so it could be a fantastic opportunity. And, it's very difficult to time the market. So who knows if it's exactly the right time. But what I'm looking at is, hey, stock market's at all-time highs. Real estate's at what looks like to be like a cyclical low. It might be a great time to rotate. And with 100% bonus depreciation, you can offset a lot of those the stock market gains.
What real asset exists that 95% of real estate investors know virtually nothing about? It's right under your feet and can perform just as well or better than traditional real estate. We're talking about oil and gas. Mineral rights are unique. It's a deeded real asset that qualifies for 1031 exchanges and can be held in a self-directed IRA and generates monthly royalty income without the headaches of tenants or property management. And for high income earners, working interests offer something rare: 100% first year tax deductions against W-2 or 1099 income. Eckard Enterprises has helped accredited investors build wealth in U.S. energy for over 40 years. Their assets are deeded, titled, and directly owned in perpetuity. Many are passed down for generations. To learn more about how oil and gas can support your tax strategy and long-term income goals, visit www.eckardenterprises.com/taxsmartrei. Again, that's www.eckardenterprises/taxsmartrei. That's it for now. We'll dive right back into today's episode. That's good insights there. We definitely can't be giving financial advice on here, but for sure. We'll circle back to some tax things in a second here, but kind of my question is, I'm a limited partner. I invest in a lot of deals. I'm fortunate to have stopped my investments in multifamily in 2021 because I saw what was coming up the pipeline, and I didn't get washed out in the bloodbath of all these capital calls. Smart. There's a lot of syndicators out there, and someone like just for myself, for example, I'm very fortunate to be able to generate very good deal flow in that space. So if someone is considering, if they're looking at a lot of syndicators, what are the top things you want to look for in that person you're investing with? What are the top things you want to screen for? Because, as a limited partner, should limited partners be going and doing the underwriting on the properties and verifying the metrics that the syndicator has or the sponsors put together? Or should they just be trusting the sponsor to have put together that information in a good way?
I think that, it's sort of like dating. If you live in a small town, you don't really know what's out there, And it's the same thing for a lot of newer LPs, is they have a very narrow scope of their network. We talk about this all the time, which is one of the things that we try to do on our podcast, is give our listeners an expanded network, is expand their scope so that, as you build your network and your knowledge and your just the people in the alternative investment space, your vision goes from sort of tunnel to more wide. And oftentimes people jump into the first deal that they see with the first person they get introduced to. And it's very difficult to tell whether that's a good deal or not so good deal because you have no context. If I tell you the number is 67, is that high or low? It's like, it depends on the number set. I have no clue. So I think the key for LPs is to, don't jump into the first deal you see. Meet some people, go to some real estate conferences. You're already on the right track by being in attendance of a summit like this. But learn, grow your network, look at a lot of deals. And no, you don't need to go and redo homework, and you don't need to learn how to underwrite, but you should definitely know how to ask some more intelligent questions like, okay, hey, what's driving the underwriting assumptions? And get the numbers set, right? Because if they say, well, we're expecting to exit at a 5.5 cap rate, does that make sense to you? Or do you have no idea whether that's high or low? That's where I think the education needs to come in, is to build context and build some just perspective and context within the space so that you can get a reading, a gut feel on whether this sounds reasonable or not. That's the best thing I could offer for that.
Yeah, no, that's good advice. That's good advice. Before we kind of pivot into the tax and accounting side of the equation here, if investors are tuning in here to this Tax and Legal Summit or Tax and Legal Wealth Summit, today, or perhaps on the podcast, and they want to learn more about Turbine, they want to learn more about you, what you have going on, what would be the best way for them to do that?
Thanks. So we primarily cater to airline pilots, but we are open to everyone. Of course, we don't discriminate. We do help some other professionals as well. If you're a high W-2 earner, it really doesn't matter whether you fly airplanes or you're, an orthopedic surgeon. You've got the same problems that any high income W-2 earner has, and that's high taxes and, less than ideal exposure to alternative assets usually. So you can find us at turbinecap.com. We are a fund structure. We're not a vertically integrated firm. So we work with a number of partners throughout the U.S. We try to aggregate the absolute best partnerships that we can across multifamily, industrial, self-storage, some oil and gas, some debt. So a very, very diversified menu of offerings. So turbinecap.com, check us out. You can also reach out to myself directly at Tait, Tait, at turbinecap.com.
All right, cool. So for everybody who is tuning into the podcast version, this will have that, of course, in the show notes. And I'm sure this information will be distributed if you're here live at the Tax Legal Wealth Summit this Friday. Tait, I wanted to pivot a little bit. I know you do work very closely with our team, Nathan, regarding tax strategy and tax planning and like that type of area. Kind of want to get your take on what are the biggest tax takeaways or biggest items that had the biggest impact for you?
Yeah. So first of all, Nathan is fantastic. My tax strategist. Personally, we actually just co-authored an eBook. It's 30 pages long. It's about the tax benefits of oil and gas investing, which can be very risky. But if you do it right and over the long term and you're long-term focused, it can be a fantastic addition to your portfolio. So in any case, maybe we can link that in the show notes. Nathan's got a beautiful headshot in the back of it, and and it links to your services as well. But in any case, that's one. Oil and gas, if you are investing in drilling, you can write off usually 80 to 90% of your investment amount in the year that you invest. So if you invested in 2025, you'd be able to take, $100,000, you'd be able to show a K1 that's 80 to 90% negative. Now, the key and the differentiator between real estate and oil and gas, as most people on this webinar probably already know, real estate is passive. 1986, the IRS put up a wall between active and passive, and they grouped real estate into the passive activity, right? So it doesn't matter how involved you are, unless you're claiming rep status, real estate professional status, all of those real estate losses are going to be passive. And if you're investing as an LP, then of course, they're going to be passive. So it's not going to be able to go and offset your W-2, unless, of course, you're an avid follower of the Hall CPA team and you've got your rep status locked up. Then maybe your situation is different. But for most people, real estate losses are passive. Oil and gas is non-passive, and there are some caveats. You have to come in as a GP with some additional liability during the year that you invest, and then we can everybody flips to an LP in the subsequent year. But that is a really powerful tax strategy that I've personally used and a lot of our investors use to mitigate their W-2 income. The other one is short-term rentals. Which we can dive into.
Yeah. I was going to say short-term rentals. I don't know, Ryan, what do you think? Do you think we should dive into short-term rentals here?
We could. I mean, we have spoken about that a lot. If you think, Tait, like that's also something that you have used or you've seen your pilots in general, and we've worked with a lot of them, we've seen that very much used along with oil and gas. Very common for airline pilots who you mostly work with being W-2. Employees, not these kind of business owners or whatnot. That's something very common. So yeah, I mean, we can talk about that a little bit just for maybe some of you here, like, oh my God, don't keep talking about that here. We've talked about that a lot. Otherwise, for some of you here, like, hey, I don't know, right? Tell me about that. So I could see us going either way. Up to you guys.
I can provide some additional color on it that I think will be useful. So just for a quick recap, real estate, you can bonus depreciate real estate, right? And so you can generate really healthy losses through real estate. And in some very low risk deals, you can generate K1s that show losses. It's just the problem for most W-2 professionals. They don't have a huge appetite for that loss. We give you a K1 that shows a $50,000 loss. You don't have any passive income. There's nothing you can do with it. You make 600 grand a year, you're still paying taxes on 600 grand. So the short-term rental loophole, and I'd love to get your opinions on how much longer this will exist, because everybody's complaining that, it's contributing to the housing crisis and yada, yada, yada. And also, I think a lot of people buy short-term rentals for the wrong reason. They say, I'm going to buy it for the tax write-off. And then they end up hating running an Airbnb. And although you really only need to do it now that we have 100% bonus depreciation for the first year, and then you can flip it to a long-term rental the subsequent year. But all you got to do is buy it, manage it for 100 hours, and more than everyone else. Correct me. You guys are the tax professionals here.
No, you're right. You got it.
Yeah. So 100 hours and more than everyone else, and then put it into service before the end of the year. So it's September right now. This is the perfect time to start looking for your short-term rental, because there's a 30-day escrow period, right? So if you find a great property, I don't know when this is going to air, but in late September, early October, that takes you into late October, early November. You close on it. Now you've got 6 to 8 weeks to buy the furniture and set it up on Airbnb and do all the things. There's a great book by Dan Templin was on our podcast. He's got some great stuff. We'll link to it in the show notes. It's called Optimize Your B&B. And I'm drawing a blank on the author's name right now, but it's a really great book. I would say get your spouse involved. If you're looking at a short-term rental, there is no way that I would, I'm not going to say I wouldn't have bought if I wasn't married and my wife wasn't incredible at managing this stuff, but it's just so much. We said multiple times when we were furnishing this thing and running around to furniture stores, and we went to the UPS store one day and we had like 67 boxes that they were holding for us, and that would just be miserable by yourself. So do it with a friend, do it with a spouse, make it fun. But if you're just buying it for the tax benefit and you're trying to do it like across state lines and by yourself, you're probably going to be miserable. So make it fun. But if you find a property, you've got 6 to 8 weeks to furnish it and do all those things, log it. You've got plenty of time to get that 100 hours in before the end of the year. And you just have to get it in service before January 1st. Now, it's my understanding that you don't even have to get it rented. As long as you take screenshots and it's in service on Airbnb, we always tell our friends and listeners and investors, it's probably a little cleaner during an audit if there's actually a booking.
Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode. I'll comment on that, Ryan, then I'll let you answer questions. I do have an opinion on how long this will last, and I'm happy to share that on this episode. Regarding the short-term rentals, you do need to have at least one customer stay, at least one guest period of customer use, if not two, so they can't argue that there's not an average. Okay. There was a tax court case.
This is good.
There's a tax court case that Justin, I believe, found, Justin Shore on our team, and I forgot the exact case off the top of my head, but it had to do with a yacht. And but the yacht was being rented for 7 days or less, or that was the intention of the yacht owner. And what ended up happening was, in that case, the tax court had determined, the judge had determined that without any periods of customer use, it's impossible to determine the average period of customer use. So therefore,
that's a really good tidbit. So I'm taking that away from this.
So you do need to have it. We recommend two, because if you look at some definitions of average, the average is sometimes they'll define it as, the average of two numbers, right? And whatever that arithmetic definition of that would be, but they say two numbers, right? So if you only have one stay, then some may argue you can't have it. We've not seen that yet, to be very clear, in an IRS audit, but that tax court case does make it relatively clear that you do need to have at least one person. But having said that, Ryan, I'll let you go with your opinion there.
Yeah, definitely have to have a stay. Would agree. But to go to your question, Tait, the first one, which I always find like most fascinating, because you go on social media these days and you go to Instagram, LinkedIn, X, whatever it is, you've got these people talking about short-term rentals, kind of like us, for sure. And a lot of people are going to reply into that, say, that's risky, that's going to go away soon, blah, blah, blah. I don't know if I buy that today. I think, yes, we've seen new regulations with cities saying, hey, we're going to crack down on this. HOAs are cracking down on these things and so forth. So there's a little bit of like, yes, kind of regulations coming in, but you do have pockets of all states here in the US where they have been vacation rental markets for 100 years, 50 years, whatever, like decades, right? And so those places have already been kind of the economy that is supported in that area is all around vacation rentals. It's all around the tourists that come in every summer, every winter, or wherever you're in, the Rocky Mountains, the ski people come in, and the whole economy is supported by that. So I don't think there's as much risk for that. And because this, strategy, this regulation specifically that kind of carves out rentals with an average stay of less than 7, that's also been around for since the 90s, the 80s, something like that. So also been around for decades. I also think about when I hear politicians over the years, they're trying to get rid of things like step up in basis and 1031 exchange. They're like, oh, these are the ultra wealthy, loopholes, right? Never have I seen, at least, or heard that they're going to try to get rid of the short-term rental loophole. And maybe that's something in 10 years from now where that's realistic. But now that we've brought back 100% bonus depreciation, there's all these things. I just find that in today's world, in 2025, September, I don't foresee anything to me that would say, oh, it's on the horizon that it's going to go away. So that's my own opinion around that.
Yeah. No, I was just going to say with 100% bonus depreciation as well, I don't care as much, right? If I'm in the prime earning years of my life, I don't really care because I'm going to get most of the depreciation on that property in the first year.
Right.
And so if they take it away next year, it's like, okay, well, bummer, but I got it.
Oil and gas.
Yeah, oil and gas. Thomas?
Yeah, no, I appreciate you bringing up oil and gas too, because that is another strategy that's effective. But short-term rental wise, like Ryan mentioned, we don't see any talk about removing or changing the legislation around what makes this tick. My opinion on it was before 100% bonus depreciation return was this is largely going to be settled at the local and state levels who are regulation, the HOAs, like Ryan's saying. I think that's going to make it restrictive enough over time. And then I also said that with 100% bonus depreciation or bonus depreciation in general phasing out, that it would take care of itself. But now 100% bonus depreciation is back. What I think is the bigger question is, it's a shame to see all the money that people are pouring into short-term rentals because they're able to get the tax benefits with short-term rentals specifically, rather than maybe pouring it into affordable housing or solving the overall housing shortage. And it's just the same that 469 in general is blocking that. And look, I'm not a politician, nor have I looked at the federal budget to see what impact Section 469 is having on the budget or what types of revenues are being generated as a result of that. But it's just really a shame to see that we have a housing crisis instead of people going to build new housing or gentrifying areas, which we do have the Qualified Opportunity Zone Fund Act or whatever, fund program. But just a shame that you don't see more money pouring into other areas because of Section 469 is being restricted. So that's just something to think about. But yeah, I don't foresee short-term rentals going anywhere.
Yeah, in the short term, I think that it's getting a lot of attention. And, in another 5-10 years, if there's attention put on how are high-income W-2 earners getting out of their tax bills, just like in 1986 when the passive activity rules came in, it's my understanding that was because it was a bunch of high-income earners using real estate to write off, and they weren't paying, a bunch of high-earning doctors weren't paying taxes. I could be wrong on that, but yeah, I think that because of the dynamic within the housing market, and when you look at how can high-income W-2 earners offset their taxes, really there's 3 bullets: 1, short-term rentals; 2, oil and gas; 3, start a side hustle, start a business on the side, and so that you can run expenses through it. That's really it. And so if Congress moves to start closing some of those loopholes for high-income W-2 professionals, there's a whole other can of worms with ultra high net worth, because there's, dozens of different strategies, the step up in basis and the 1031 exchanges, and there's being able to borrow against your equity instead of sell. There's all sorts of stuff. But I think for the upper middle class people, it's pretty straightforward. I don't know. Do you guys have any more than those 3 that are kind of those silver bullets?
Tom, you're on mute if you want to jump in. I think I know what Tom's going to say, but I'm curious to hear what he says.
Yeah, no. So those are the biggest ones. There are charitable giving strategies that you could explore that can take assets A, out of your state, and then B, allow you to get a deduction now and still benefit from those assets. They're called CRUTs and CRATs, and things like that. I don't want to go too far into that. That's more in the financial planning space, but that is an option. The issue with that is most people in their prime earning years, right, who are in asset accumulation or wealth accumulation stage, don't want to be giving away their assets. And I mean, that's different. It tends to be the case, right? Sure, maybe somebody came into a huge boon of tens of millions of dollars. Like the number could be different for everybody. And maybe they don't mind doing that. But usually when you start talking about charitable giving in any significant way, that's going to take assets out of your estate or out of your control during those prime years of asset accumulation. It tends to be a conversation that kind of sounds good in the beginning, but that really never goes anywhere, at least in my experience. But there are no other ones. The other one is to fundamentally shift, if you're a W-2, fundamentally shift how you look at earning and go more the business route. Now, with that comes more risk, more responsibility, more things you have to watch out for. But then that way you do open up your path. Like, Tait kind of mentioned before, you can do a side hustle. One of my friends who I just spoke to yesterday, he owns a vending machine business and he's able to write off all of the vending machines because they're 5-year property. And that's
his cell phone and his, it's like you can start running things through the business that you were going to spend money on anyway.
Right. And that becomes a shift in the way you look at earning, because the W-2, you are capped at the benefits that you can even get when you do execute these strategies at $626,000. So it's the max loss you can take. So it's kind of rough. But Ryan, what's your take?
Well, I just wanted to add one more thing that Tait, you had kind of said earlier, which is like, hey, if you're thinking about this, like it's short-term rentals, and that is super common. But you kind of said earlier, which I appreciate, which is like, don't just get into this for the tax savings. And I would agree, because because what happens, and I've seen this actually with just a few, it's rare, but with a few clients, is you get into this looking for tax savings and it's 12 months, 18 months in, and you're like, holy cow, this is not going well. I'm losing money hand over fist. I didn't have enough reserves in place to actually afford these things, or when I have like these off peaks, because vacation rental markets, that's really common. And so you get into this and you've sold a bunch of stock saying, hey, I'm going to afford the down payment by selling a bunch of stock that I've got and push it in here. Now you've got a taxable event, right? So now you got to pay that tax, and then you've got potentially issues with reserves. So I've seen people in 18 months when they got the property to sell. And I was like, why did I do this? Okay. So, but the other thing too, if you are someone who can get through that first year and it's okay, and you get that kind of dopamine hit of like, hey, I got the tax savings, cool. If everything's going okay, you're probably going to keep going. And that's really, I think, kind of who this is for. And for some of you, it's going to be just a learning opportunity where you say, hey, I messed up, but I want to keep going. I see the tax benefits. I see that I made a mistake on this one investment because this is my first time, but I want to keep buying this asset class. I like the idea that it's in a good market that is probably going to appreciate long-term over time. It's in a place where I can earn a higher revenue kind of per person, and it's probably a good, high quality property just in general. The location, the property, and the cash flow and the people that you're getting is all high quality. So I think some people really are just attracted to like kind of the perception of the quality of just that home, right? The land that it sits under, it's in a good, all those things I just said, compared to like, hey, I'm going to go buy, I'm in Minneapolis, Minnesota, Tait, if you're like, where are you? So it's like, you go buy something in like middle of Minnesota and it's a 20 unit, thing. And it's like, okay, like, where is this? And yep, I got this cool property. Maybe you're just out there for the cash flow, and that's great. But some people, I think, like the idea that the quality of their property is almost like a, hey, this is really cool. And you're probably not going to go stay at your 20 unit to say, hey, I'm just going to come visit there for a weekend, right? You're probably going to go, though, if you've got a property in Miami, Tom's in Miami, you might be actually going there to like stay and vacation and take care of some things. That's cool. That's an added benefit you could get.
Few tips here that I think are really important. One, do not buy a short-term rental somewhere where you don't want to go. I've made, don't buy any property somewhere you don't want to go. I've made this mistake. And, I bought a property that was a lot of time zones away from me in a market that I didn't really particularly care to visit. And so it's a multifamily with a property manager, but like a property manager is not going to take care of it like you're going to take care of it. And I don't want to I fly for free, and I still don't want to spend 2 days out of my life to go to a market where I don't know anybody. I got to stay in a hotel. It's just a pain. And, we have a short-term rental. It's in Reno, where we live a little more than half the time. And so it's down the street. It's where we stay when we're there. I don't know. It's very convenient. And every time we go, we furnished it really nicely. and the artwork is great. And, I mean, we got really good reviews. It's the highest reviewed Airbnb in Reno, Nevada. And you'd be surprised what people go to Reno for: horse shows, weddings, college graduations, car shows, all sorts of stuff. And even some people that stay in Reno when they're skiing. But every time we go, there's issues. There's stuff out of place, or something's broken, and it's something the cleaners don't catch. So don't expect to buy a short-term rental in some faraway market and expect your cleaners to take care of it for 12 months without you putting eyes on it. This is active. There's a reason it's an active tax benefit. It's not something that you can just set and forget. So it's fun, but make sure that it's somewhere that you actually want to go stay, in a market that you actually want to visit. And then the next thing I'll say is be careful with regulation. You mentioned, there's a lot of places in the Rocky Mountains that people go to ski, that the short-term rental is sort of embedded in the community, right? Because it's right at the base lodge. Yeah, that's great. But if you buy 5 minutes away in a suburb, be really careful and make sure that, if the regulation changes and you get your permit pulled, or they bring in permits and you don't get one, that it doesn't completely crush your business plan and you're going to be negative cash flowing. You're going to have to settle at a loss. Don't buy a property that you're going to be screwed if you can't short-term rent it tomorrow.
Yep. And I think we've had other people on the podcast who kind of do short-term rentals, like really just focused and dialed in on that. Basically look for that vacation rental market that already has been established with those regulations. Not like, hey, we have no regulations. That's an issue because it could go either way. Really positive, like, hey, this is fine, or like really negative, like this is absolutely nothing we can do. So if you can at least find a market where there's already regulations and it's kind of tight, then you can walk in to say, I either take this or I leave this. I'm not going in to change. There's nothing that's probably going to change because these have been the regulations for a long time. So you can reduce risk. I think that's really ultimately what's going on here is you go to a suburban, Denver market close to the ski areas. If there's nothing there, you just have a risk that it could go either way. It could be positive. That would be great. But you also have the option that it could go negative. So if you can go to something that's established, you just reduce a lot of that risk.
Yep. And I said suburb. I kind of meant neighborhood,
Yeah. No,
neighborhood that's like adjacent to the ski hill. That's dangerous.
Right.
Because the community could get together and say, you know what, we want to ban all the short-term rentals. And that's fine if that happens 3 years down the road, as long as you can sell it for more than you bought it for, or as much, or you can long-term rent it and it's not going to completely destroy your business model.
Right. That's good advice. So I think we have one question here. We'll take this question and we'll wrap it up because we're coming up on time here. So we're going to appreciate everybody for tuning in with us, whether you're here live or on the podcast. This question's from Anna. With the new changes to bonus depreciation, is it correct that basically means that you could purchase a new property and it only has to be a short-term rental for the first year? Then it could be a long-term or short-term rental going forward. So yeah, bonus depreciation hasn't really changed that. The implementation or the renewal of 100% bonus depreciation or extension, however you want to look at that, hasn't really changed that. It's always been the case with short-term rentals. Now there are some opinions out there that make flipping it directly into a long-term rental too shortly after making a short-term rental could be risky. We don't have any evidence of that at the moment, but just did want to throw it out there. So long story short, short-term rental year 1, long-term rental year 2. Certainly possible. Just make sure you're getting with your tax professional, understanding how all of that works. Make sure you're walking on the right side of that line. But Tait, want to leave you with the parting words here. Anything else that investors should be aware of? Anything else that's pressing right now you think you'd want to leave us with?
Yeah, I just wanted to leave people with some thoughts on alternatives versus the stock market. And first, I'm going to quote Tiger 21, which is a membership organization for high net worth individuals. And there's an asset allocation report that comes out every year. And they survey individuals with net worths exceeding $100 million. And their typical portfolio is 18% public equities, 31% private equity, 27% real estate, 10% fixed income, 10% cash and equivalents, 2% hedge fund, 2% crypto, art, commodities, et cetera. So that's the first, point that I want to make is that ultra wealthy people, typical, high W-2 employees, high income W-2 employees have a big stock portfolio, equity in their home, and some various other, maybe some rentals. That is completely different, fundamentally different than how the ultra wealthy invest. The next thing that I want to point to is this new executive order that was signed on August 7th, I believe, August 12th. And it's called Democratizing Access to Alternative Investments in Defined Contribution Plans. What does that mean? It means alternative assets in your 401k. For pilots used to have pensions. Like everybody used to remember, the Pan Am days, you retired, you got a pension. Well, that after all these rounds of bankruptcies, all the pensions went away for pilots. And it's been the case for a lot of other people too, where pensions have gone away and they've been replaced by 401k plans, defined contribution plans. So we've gone from DB to DC. Defined benefit plans, pension plans, on average, invest 30% of their investable assets into alternatives. Whereas defined contribution plans, 401ks, it's 0.1%. And typically because, if you're with Schwab or Fidelity or whoever, they only allow you to invest in public market securities. There's another problem with this. In the late 1980s, there were about 8,800 publicly traded companies. Today, there's 4,300. So why do you think the stock market is so overvalued? At the same time, 5 times as much money in defined contribution plans. So you got trillions of dollars of retirement funds. And that's money that's coming in like clockwork every 2 weeks as all of these W-2 employees in the entire United States are getting paid. There's more money being pumped into defined contribution plans, and there's 4,300 places for it to go. That's it. And so why do you think Apple and Tesla and Nvidia are at these screaming high valuations? Is because there's trillions of dollars that are all chasing this basket of 4,300 companies. So I think that there is a shift coming. There's a structural shift in the capital markets coming, and it's already here where people are recognizing that, hey, this is not how the ultra wealthy invest. Yes, it's a portion of their portfolio, but it's not the whole thing. And there's definitely a shift coming in terms of how people invest their retirement funds, and also a recognition that this isn't fringe risky stuff. This is core, real, oftentimes very low risk stuff that people should have access to within their defined contribution plan. So happy to see that. That's not a political statement whatsoever. This is just a fact. And the fact that it's getting some attention, it'll take a decade for this executive order to work its way through the system. But I'm certainly happy to see that access to these types of opportunities are more widely available to people.
Yeah, that's a good parting take on that. I know that there's some other things I think with the accredited investor rules that they were exploring, other ways to kind of loosen that as well. I don't have the specifics offhand, but yeah, I would generally agree that people should be able to make the decisions that they want to make with how they want to allocate their portfolio, and there should be less regulations. But it all goes back to kind of what you said before, Tate. Got to make sure you're investing with the right person, because there are bad actors out there. There's been some scandals and Ponzi schemes that have for sure went around
Absolutely.
The space. So just got to be careful. But
I think that's where, and I know we're almost at time here, but I think that's how it will manifest itself. Is there will be actively managed private portfolios that are now accessible within a DC. I don't think it's going to be like you can self-direct your 401k into anything you want, because there's definitely the risk of people making some, questionable choices. And, you obviously don't want a bunch of people losing money in their retirement accounts. But yeah, I'll leave it there.
All right. Well, thank you everybody for tuning into this week's episode of the Tax Smart REI Podcast, whether you're here live or listening to the recording. It's been a pleasure. Tate, thank you so much for joining us. The Tax Smart Real Estate Investors Podcast is for general information purposes only and is not intended to provide and should not be relied upon for tax, legal, or accounting advice. Information on the podcast may not constitute the most up-to-date legal or other information. No reader, user, or listener of this podcast should act or refrain from acting on the basis of the information on this podcast without first seeking legal and tax advice from counsel in the relevant jurisdiction. Use of and access to this podcast or any of the links or resources contained or mentioned within the podcast, show, or show notes do not create a relationship between the reader, user, or listener of the podcast and the host, contributors, or guests. Any mention of third-party vendors, products, or services does not constitute an endorsement or recommendation. You should conduct your own due diligence before engaging any vendor. For more information, reference the show notes or description of this episode.